to the deep dive. Today, we're really digging into what's been moving the financial markets lately and some key policy debates that are bubbling up. We've got a great set of articles here from Fund at Mental. Our goal, as always, is to pull out the core insights for you, kind of give you the shortcuts so you're informed without reading everything yourself.
Cut through the noise.
We'll go through them one by one. So, okay, let's start with this first source, Behind the Rally.
Okay.
This piece points out that, wow, major U.S. stock indices didn't just recover from that dip, they've hit new highs. We're talking 141 days later.
A quick turnaround.
Yeah, the S&P 500 up over 30% since the April lows. That's what, 1,540 points in 5 months? Apparently one of the strongest recoveries since 1966.
That's a serious bounce back.
And the article highlights two big reasons why. First, U.S. companies announced over $1 trillion in buybacks just this year to date.
The fastest pace ever, right?
Fastest ever. And second, margin debt is also at an all-time high, just over $1.02 trillion. So, together, those two things, they apparently explain about 20% of the market's massive $10.8 trillion gain since April. Oh, and M&A is up too, reducing the share count.
And what's really insightful there is that 20% figure. It tells you a chunk of this rally is fueled by, well, buybacks and leverage margin debt, not just pure earnings growth.
Right.
So it prompts a question for you, really. How sustainable is a rally when it leans so heavily on those kinds of mechanics?
That's a great point, and it kind of sets up our next piece nicely. This one's called Full Circle.
Okay.
Remember earlier this year, all that talk about the end of U.S. exceptionalism, because international markets were doing better.
Yeah, Europe, emerging markets, they had a strong start.
Exactly. European indices gave like 3 times the return of the S&P, but now, well, story's flipping again.
Oh.
Yeah, now the U.S. is the only market where analysts are showing net positive upgrades. Everywhere else, downgrades or just balanced.
That's a quick shift. Back towards the U.S.?
It suggests sentiment is turning positive again for U.S. assets, maybe because of perceived effects from tariffs on margins, though it's volatile.
So if you connect that back, you've got this rally, partly fueled by mechanics, and now analyst sentiment swinging back positive. How do you, as an investor, weigh that sentiment against, say, fundamental value, especially with the marquee concentration we're about to get into?
You read my mind. That leads us straight to, it's going to get bumpy. This one focuses squarely on NVDA's Q2 earnings.
The AI powerhouse.
Right. And the earnings were good, mostly impressive, but investors seem to want even more. Analysts expect over 50% growth for the next 3 quarters.
Which is incredible growth.
But the article asks, does that justify a 57 PE ratio? I mean, that's sky high compared to the average.
Yeah, the market average is closer to 20.
And NVDA matters so much because it's over 8% of major indices. And it's the anchor for those other big tech stocks, the magnificent ones.
Which together make up, what, over a third of the S&P 500?
34%, yeah. So NVDA's fate is kind of tied to the whole market's direction in a way.
That really drives home the concentration issue. I mean, think about the implications. So much riding on just a handful of stocks, it feels precarious.
And that precarious feeling is echoed in this next piece, Bubble Talk.
Okay, bubble talk. Always gets attention.
This one makes a pretty stark comparison. It goes back to the 1989 Tokyo real estate bubble. Remember when the Imperial Palace grounds were supposedly worth more than all of California?
Okay, vaguely, yeah. Crazy valuations.
Well, today, NVDA's market cap is only about $1 trillion less than the entire Japanese stock market. You know, the world's second largest.
Wait, say that again? NVDA versus the whole Japanese market?
Almost, yeah.
Right.
Just $1 trillion shy. So the article basically asks, right, something's got to give. Either the rest of the stocks catch up to this hype or, well, the bubble bursts.
That historical parallel is quite something. It really makes you pause and think critically about these current valuations, doesn't it? Even if it's not a perfect comparison. Is the market really betting everything else catches up?
Adds another layer of risk. Which brings us to beware of Greeks. This isn't about ancient history, it's about options market stuff.
Ah, the technicals. Gamma. Vega.
Exactly. So at these all-time highs, the market's accumulating risk under the surface. Investors want protection, but they're also speculating. Euphoria phase? Maybe.
Could be.
This makes things tricky for options dealers. The article talks about gamma, basically how fast an options price changes. Right now, gamma is apparently big and negative.
Okay, and negative gamma means?
It means if prices start falling, dealers hedging their books are forced to sell more aggressively into the decline, which makes the fall worse. It amplifies the move.
Like pouring fuel on the fire.
Pretty much. And add to that, the net short position on VIX futures, people betting against volatility, is the biggest it's been since 2022.
So if volatility does spike,
Mm-hmm.
you get a squeeze.
Exactly. So you can see how maybe even good NVDA results that just slightly lower future expectations could trigger something bigger, given its weight and these technical factors.
Right. It helps you understand the plumbing of the market, how a small move could potentially accelerate very quickly.
Okay, let's shift gears a bit. Let's talk policy. Next up is policy adjustment.
The Fed, Jackson Hole speech.
That's the one closely watched. The chairman basically said, look, risks to inflation are tilted to the upside and risks to employment to the downside. He called it a challenging situation.
Balancing act.
Totally. But he also hinted at potential rate cuts, maybe as early as September. He mentioned the shifting balance of risks may warrant adjusting our policy stance.
And the market liked that, I bet.
Oh yeah, equities popped immediately. But crucially, he tied everything to incoming data. The September jobs report, CPI, and you've got external stuff like tariffs potentially causing price spikes too.
So it really puts the Fed in a tough spot, doesn't it?
Yeah.
How do they balance those opposing risks, inflation versus jobs, especially when every decision hinges on the next data point? It's a constant tightrope walk.
Absolutely. Which leads to our final piece, cause versus independence.
This sounds like it might get into politics a bit.
It does, yeah. It discusses President Trump's stated goal of lowering interest rates. And some tactics mentioned, like a letter about Governor Lisa Cook regarding alleged mortgage fraud, framed as part of an effort to pressure the Fed.
Trying to influence policy.
The article presents it as a push to get the Fed to align with his views, possibly by replacing FOMC members. And this raises that fundamental question: should the Fed be dependent on the executive branch?
The independence question. It's crucial.
Right. The piece asks about checks and balances. If a president appoints new governors who serve 14-year terms, remember what happens if their views later clash with the president's agenda.
And the market reaction. If the Fed is seen as less independent, especially with the dollar's role globally.
Exactly. That's the core concern raised. How would markets perceive a watering down of the Fed's independence?
What's fascinating there is it's not just about economics, it's about fundamental governance principles. For you listening, it really highlights the potential long-term ripple effects on global financial stability if that central bank independence erodes.
So, wrapping this all up, what does it mean for you? We've seen this rally partly driven by buybacks and debt.
The mechanics.
We've seen sentiment swing back to the U.S., but also huge concentration risk, especially around NVDA, with some bubble talk comparisons.
And those underlying technical risks. The gamma, the VIX positioning.
Then we layered on the Fed's tricky balancing act between inflation and jobs.
And the really fundamental questions being raised about central bank independence.
It's definitely a complex picture. Everything feels very interconnected right now.
Absolutely. Understanding these different layers, how they influence each other, is really key to making sense of things.
So here's a final thought to leave you with. Which of these forces, the market mechanics, the concentration, the policy challenges, the independence question, which one do you think will ultimately be the most decisive in shaping the market's direction next? Something to ponder as you continue your own deep dive.